Welcome back to another stock market open. So today we've got a little bit of the Nasdaq caught in that no man's land again, which kind of makes sense that you get a little bit of volatility. But then again, that's sort of what we signed up for in the stock market for 2023. Take a look at obviously as even we had our sort of more straight Nike swoosh portion here, minus the volatility here. A lot of red in between. Very common though, so not unusual for us to probably honestly pounce back there to the Nasdaq 373 after that amazing November. But it'll be interesting to see how things evolve. Mostly, I think the biggest data sets markets are going to be looking for now are going to be number one, jobs this Friday, and then of course the Federal Reserve. Any kind of commentary that we get, and that's already coming up. Next week, actually. So we've got the next Fed meeting scheduled for the 12th through the 13th. 12th through the 13th, we are looking at next Tuesday and Wednesday. Today's already the 5th of December, which means we've got about 25 days left in the month. A week from today, the Federal Reserve will begin their two-day policy meeting. And then after that, we will have their press conference, obviously, set for Wednesday. So usually the days before, but sometimes even the week ahead, we get a little bit more volatility leading into that. We are also looking for some special numbers today. At 6:45, we'll be getting the S&P services and composite PMIs. We'll also get JOLTS. That'll probably be the most interesting number today. You'll get ISM services, prices paid. People will be paying attention to that for services inflation. You don't know that we're highly worried about inflation exploding again. Obviously, we want to watch to make sure that it doesn't. But JOLTS today is probably going to be the most entertaining, especially since the labor market will be coming into such focus. On Friday, we'll have the labor report. Again, on Friday, we are expecting a labor report of 189,000. I feel like that adjusted a little bit from 180 yesterday. But anyway, 189,000 is the current estimate. We also, wow, almost forgot. A week from today, we have another CPI report. How fun. So on the 12th is our next CPI report. So think about this. In the next 8 days, we have some pretty big catalysts. We have JOLTS today, ADP Wednesday, so tomorrow, Jobs Friday, then you have CPI Tuesday, and Fed Wednesday. So buckle up for an eventful next week. It's going to be quite entertaining for sure. We'll obviously cover it here, but it wouldn't surprise me to see, let's put it this way. Generally, we wouldn't expect all-time new highs, just moments before some of these larger catalysts here. So paying attention closely to these. We also have the bond market slipping a little bit this morning in terms of yields. So prices for bonds up. We're looking at 4.218 on that 10-year, with that Atlanta Fed now GDP read coming in at 1.2. I'm starting to set up a little bit of nervousness that is it possible you could see stocks go down at the same time as you see yields go down? Yes, of course that's possible. As usually we like to see, yields are coming down. That's good for earnings, right? Oh, but maybe not if in the event that creates an earnings recession. That is, bond yields are going down because the bond market's pricing in a recession. Who knows? Many like to say the recession already happened for stocks. It just came in rolling waves. You had your freight recession, your chips recession, your consumer goods recession. Each sector has sort of had its opportunity to come out of that recession. We'll see. Anyway, in other news, let's take a look here. Repo market spike conjures memory of the September of 2019 turmoil. September of 19 turmoil, I remember a lack of liquidity, and I remember being at Jordan Belfort's podcast, and I remember walking out of his podcast and seeing the spike in short-term yields. and thinking, "Oh no, what's going on?" It was interesting because we actually had an inverted yield curve in 2019 briefly. Did we actually invert, or did we just get close to inversion? Now I'm second guessing myself. I think we either inverted. I think we inverted very, very briefly there that summer. And the moment we inverted, I remember everybody thinking, "That's it, we're going into recession." And then it's weird because then COVID happened, and people are like, "See, there was the recession." And it's like, how did the bond market predict COVID? But anyway, yeah, it was yeah, August 26th of 29. We were slightly inverted. It's really interesting because we were only inverted like 1 basis point. Well, a little bit more. Yeah, it was like 10 basis points up to nah. Yeah, up to actually only about 5 basis points rather. Yeah. Oh, so 1 to about 5 basis points of inversion. Right now we're negative 40. So anyway. So what did we got today? Spikes in key short-term interest rates are raising eyebrows in the arcane but vital overnight funding market of the repo market, drawing unsettling comparisons to turmoil of 4 years ago. Strains started showing up regarding liquidity last week. Uh-oh, this is where people like to talk about things breaking. The bond market frenzy that stoked November's U.S. debt rally led to a surge in demand for financing in the repurchase market, where participants engage in short-term lending. This has led to a large jump in short-term rates on the final trading day of November, with yields on overnight collateral jumping over 5.5%. Even more unusual, the elevated levels persisted going into December. Ooh. Let me pull the effective Fed funds rate. Let me see here. I want to see what they are seeing. Okay, we have that. We've effective Fed funds rates 5.33, and that's stable. So where is our repo rate? Let's see here. Repo operations. Those were on November 30th. Here we go. Overnight repo for Friday, trading at 5.45. And went as high as potentially 5.52. Very interesting. All right, let's keep seeing what we have here. Oh, here's a little tool to kind of show you the abnormalcy. I'll pull that 1 second here. We'll get this ready for you. And we'll take a look at what this is. This is often where the Fed starts getting a little more dovish. They don't like it when there isn't liquidity. But then you wonder, is it too late? Have you broken something? That's actually what a lot of bears have been talking about, that the pain isn't in the quiet. The pain is when something breaks. But anyway, I'll pull this chart up in just 1 second. Let's see. It looks, walks, and talks like September of 2019. But I don't think it's being driven by the same reserve scarcity reasons, says someone from TD Ameritrade. But nobody really knows when you get this kind of volatility. Demand spike caused by confluence events, blah, blah, blah. Pile of, okay. Okay, funding issues suggest that at a time when the Fed is looking to pare back its balance sheet through QT, bank balance sheets will play an important role. Well, the other thing too is the repo facility has kind of been already starting to vacuum up a lot of money. Let's see if I'll pull that up in the meantime. Fed repo facility. And we'll get the outstanding balance on the St. Louis Fed. And you could see this drop of excess money that's floating around. Here you go. Look at that. So this is the repo facility. How much in the reverse repo facility, how much money, how much excess money we sort of have on deposit with the Fed. This is what the Fed's trying to vacuum up. This is partly blamed or blamed on what caused all of the inflation, all this excess funding and availability for loans and borrowing and spending and speculating. Now, this same market has interest rates associated with it. And I'd like to get this chart to pull up, but for some reason, my Dropbox isn't syncing. Point is, there was a little spiky dude law. Yeah, how interesting. This morning I cannot get out the sink. Oh well. Anyway, so we'll pay attention to that because that is very reminiscent of what happened in 2019. 2019, I want to say ran up to like 15% or something for a night or for a day. Fed's like, oh, we are actively paying attention to this. So it kind of ended up turning into something larger. Hmm. Oh well. All I wanted to do was show you the chart going up, but I can't do it right now. Okay, we'll get to the bottom of that. So, all right, we'll pay attention to that. In the meantime, let's take a peek at some of this Bloomberg intelligence stuff I put aside here for the Fed. As of mid-October, the Fed path for the Fed funds rate implied by futures contract was slightly at odds with the Fed's and Bloomberg's estimates. By October 19th, the 10-year Treasury peaked. Prices on futures contracts pointed to 65 bips of Fed cuts in 2024 and suggested we would settle around 4.25 in 2026. That's what the futures were looking at. As of 3 p.m. on December 4th, so yesterday, futures contracts showed 125 basis points of cuts in 2024. And the most recent Bloomberg Economist outlook also calls for 525 basis point cuts next year, starting in March. Futures pricing pointed to a future Fed funds rate of 3.25 in 2026, much closer to the Fed's estimates and Bloomberg's estimates. Interesting. Okay, so what they're saying is, if you go back to October, you weren't appropriately pricing in the Fed rate cuts. And that now, after the November rally, you've started to appropriately price in what the Federal Reserve will probably do, which is cut rates next year. The question is, how much are they going to cut rates? And obviously, at this point, it's probably too early for them to actually say, oh, we're definitely done and we'll cut rates right away. It's having a conversation with this right away. Why would they not come out and suggest that's it? We'll cut rates right away, or we've reached peak. Problem with saying we've reached peak is that, at least I suspect, you would almost immediately be guaranteeing that bonds are a good investment. You'd basically be saying, hey, look, you could buy into, the 10-year Treasury bond and you're buying it at a bottom. And we're basically guaranteeing it, the Fed. And as soon as you do that, you actually encourage more people to buy the bonds. You encourage more people to buy the bonds. The price of the bonds goes up. Yields fall, you actually loosen financial conditions really quickly. So there's a quick practical recap on why would the Fed not suggest, oh yeah, we've reached peak. That's one reason. Now, when you have funding stress though, and maybe you don't have enough liquidity, the Fed saying, you know what, we are done, is a tool they could come out with. So if you keep seeing some of these issues potentially in that repo market, who knows? Maybe the Fed starts pulling some interesting genies out of the bottle, so to speak. So we'll watch for exactly that. Let's see here. Much more surprising has been the reassessment of long-term. No chatter. Let's see here. Dramatic move downward. Okay. Let's see here. Interesting. However, even though we're pricing in substantially more rates, or rate cuts rather, in the future, the market right now is looking at a potential terminal rate with inflation of closer to 3% rather than 2%. So that's interesting. Something either left to be priced in, or as people like yesterday, we saw Mohamed Alarian suggest, oh, the Fed's going to change their target to 3%. I personally don't think they're going to do that. They'll lose a lot of credibility, and they don't have much left if they did that. But we'll pay attention to that. Let's listen to CNBC for a moment. Let's see if, they're talking Bitcoin. All right, let's listen into this for a moment. Interesting. I cannot get audio on this for a moment. What is it today? Today we're just going to have technical problems? That's very bizarre. I guess so. Okay, well, we'll fix it. But anyway, all right. So we'll keep going then here. That was kind of stressful. We got to love it when you have two problems at the same time. You can't even fix one while you have the other problem. That's okay. I'll handle it live. So okay, I figured out one problem, and now we're gonna fix that, and then I'll fix the other one. So yeah, I think we are. I mean, imagine this, and this is what I always think is so interesting. Imagine being in an environment where we don't actually have funding stress. We don't have fear about runaway inflation. We don't have fear about a jobless recession. We don't have fear about, quite frankly, any of these crazy things that really are keeping so much money on the sidelines, and in many cases, rightfully so. I mean, why would you be in the market if you were at all fearful that we could have a recession, a resurgence of inflation, political issues? We got the election coming up, in less than a year from now. Now, usually election years are great, though. And one of the weird things, and this is why I so much believe in this longer term Nike swoosh that will end up looking pretty volatile in the short term, is you've got to convince everyone that, we can actually go back to a relatively decent economy. That's going to be hard. Trying to prove that we could actually pull that off, it's going to be pretty difficult, especially since soft landings are so rare. I had an email with somebody from Bloomberg the other day. I thought this was really interesting. They had an article where they discussed this idea of another 30% market drop ahead of us. And what they did is they looked at, every time the Federal Reserve's interest rates peak, they saw the market fall 30%. And so I emailed them and I thought, well, I mean, isn't it possible that we already had our 30% drop? I mean, look at what we had in 2022. To me, it seems like that would be reminiscent of our 30% drop in 2022 was quite painful for the stock market. And if you were diamond handing through 2022, you had some real cojones, because you just watched the S&P 500 go from 467 to 430 or 342, which I don't know if that was a full 30% on the S&P 500. We know it was on the NASDAQ. 342 divided by 467. Ooh, close. Almost, what is that? 26.8% on the S&P 500. Yikes. So you almost priced that in. And in her particular article, she was pricing in about an average of a 30% decline each Fed cycle, each Fed sort of hiking cycle. And so she actually emailed me back. She said, yeah, that's actually a really good observation. Now, one thing that could be different is that we hadn't hit peak rates yet in 2022. And so then, the argument gets a little nuanced, and it's like, okay, well, do you have to hit peak rates first for you to have a recession? Or is it possible that you could have actually, or not recession, but the 30% drop? Or is it possible that you pre-price in the pain, so to speak, because everybody's looking going, oh, well, we know what's going to happen here. Rates are going to go up and it's going to suck, and you're going to have a 30% decline. And then you pre-price it in. Who knows? That's an interesting one that we don't necessarily have the answer to. But I think that was a worthy debate. I certainly enjoyed the debate. So it's kind of cool. You could kind of just, most of these articles people write, they put a little email address for themselves up, and then you can debate them. So I always think that's pretty cool. Okay, we're going to try something here where we get this fixed. Give me 1 second. Let's do this, and then we'll keep chatting here. All right, should be able to hear me just fine now. And what we're going to do is we're going to restart all this nonsense. And okay, there we go. So let's get this all restarted so I can actually get things going again. I have no idea what's going on today, but you know what? Sometimes you just gotta do it live. So
S&P 500 down 0.28. You've got the Nasdaq down 0.39, and Phase down 34 bips. And Phase was positive yesterday. It actually closed above that crazy channel. That crazy downtrend has finally been broken for Enphase. Now, in fairness, it's down about 34 basis points right now in the pre-market. A lot of selling off in tech, Nasdaq-related stocks, chip-related stocks. For example, we've seen Nvidia back into the 460s. It's amazing that, actually 450s now. It's amazing that with such insanely good earnings. Yeah, the sound is going to be weird, Potter. I'm on my iPhone for a moment, okay? Chill, bro. I'm working on it. uh, so let's see. Oh my gosh, folks, chill. Just give it a second, would you? Gotta restart the system. Yeah, it's on the iPhone. Anyway, so we are going to be at. Well, we'll watch the Nasdaq and whether or not that continues to sell off today. But Nvidia at 455 after the incredible earnings that we've seen actually is still sitting at about its 100-day moving average, which is incredible. So not only is Nvidia sitting at its 100-day moving average, which right now the 100-day moving average is 25286. Oh my gosh, that's crazy. The pre-market is at 25286. Nvidia is literally sitting on the 100-day moving average. You do also, though, have the trend was a little broken. The trend line's probably weaker. So the 200-day moving average is all the way down at 383. So that's not so ideal. Hold on a sec. Oh, interesting. Okay. Let me see if I can get that live now. Or that's back online. Okay. No. Okay. I'll do one more thing. Interesting. So that's a big deal for Nvidia. I don't know. What I do think would be so interesting is to see. I'd love to see some comments from people who think that we are heading into a worse time than 2022. I do see a lot of bears that argue obviously one of two things, which I think is one of the two realities. One, that you have another severe correction that trends towards what we saw in 2022, and then others say it's going to be worse than 2022. In order to really get worse than 2022, we'd probably have to see some real serious joblessness. That joblessness would potentially start being evidenced by the JOLTS numbers that we end up getting. Let me get logged in here. The JOLTS numbers that we end up getting this morning, ADP report Wednesday, and jobs report Friday. I think that's why those are going to be pretty critical this week. And I personally think you're looking at a sideways market until you actually get through those sideways to down. But getting through that makes a lot of sense. So again, to recap what some of the catalysts we're looking forward to. Well, first of all, back to almost 4.2 on the 10-year. Then we're looking at ADP Wednesday, JOLTS today, jobs Friday, CPI next Tuesday, Wednesday Fed. Ooh, big next 8 days. So I always find it exciting, but it's also kind of like a little nerve wracking if you're in stocks, or honestly, I think there are a lot of business owners out there who are trying to make decisions for their business. And they're looking for rates to just come down so they could decide, okay, should we invest in a new, tool for the workplace or machinery or whatever? And it's very difficult to do that when the market is so unpredictable. That makes it very frustrating to actually plan for business because business is going to plan to some regard on what the consumer wants to do as well. To some extent, the consumer is also driven by the same factors. I mean, after all, we know that somewhere around 30% of GDP is driven by the non consumer portion, and 70% is driven by consumers. All right, let me see if I can get back to this particular angle here, and let's see how we're doing here. Very interesting today. I don't think I've seen this many tech issues all at the same time. Fascinating. Yeah. StreamYard has a processing issue. I can't get CNBC to play audio. Very interesting. Okay, hold on a sec. There we go. All right. At least we're back to my audio. So we're good here. So we're good to the better audio. All right. Very well. So now let's take a peek here. Let's see here. Okay. So I wanted to show you this. This is the NVIDIA problem that we're facing right now. The NVIDIA problem right now puts NVIDIA right there at that 100-day moving average. So we'll see what happens to NVIDIA over the next trading days here. Who knows? Okay, looking at some more news. If you didn't see it on Twitter, there's some crazy home explosion that everybody was sort of talking about on Twitter yesterday. The FBI or local law enforcement was performing a search warrant. The house just blew up. Jeez, it kind of makes you I mean, feel bad for law enforcement has to deal with that kind of stuff, but that's out there. It's also it's also kind of weird that during the holiday times, Christmas time, winter time, depression goes up substantially. Hey, if you're out there and need someone to talk to, there's always a very, very helpful and accommodating comment section down below. Okay, maybe not the best recommendation. Anyway, so yeah, interesting. All right, let's see here. Let's go get the latest here from Nick T, and then we're gonna go grab some bear pieces, and we'll see what some of the fun is out and about. All right, so Nick T. Good old Nick T tells us 18 hours ago, the Fed's measure of underlying inflation, the multivariate core trend, ticked down to 2.6% in October from 2.9% in September. This was the lowest reading since January 2021. I mean, at least I've said it almost every day for a year. New York Fed, multivariate core. There has been no indication of inflation actually popping back off. Instead, we've been in this environment of just more and more companies coming out suggesting, you know what, we're seeing prices go down. Take a look at the multivariate core. There was a lot of fear last month, which is crazy because last month, we had a stock rally basically. There was a lot of fear last month that this multivariate core would pop back up, and that's because you've started to see that trend move up here on the right. You can actually get it with a band. Yeah, here you go. Let's pull off headline PCE year over year, as you can see down. You can pull off core PCE, as you can see nicely down. And so you could look at multivariate core here. Nice chart here for JPOW to play with. It actually doesn't let us zoom in anymore. But what we can actually do is zoom out. Let's zoom out for a moment. There you go. So you can see this is a volatile measure. This does bounce around quite a bit. And now people are complaining about the mic. Oh, yeah. Okay. No, you're right.
There we go. There you go. That should fix the audio. Oh, man. Yeah, it's just it's a Tuesday morning. What are you gonna do? It's just lots of problems today. I don't know what to say. It's just really annoying. Yeah. Does this work?
Just close the fucking door. Close the door.
Yeah, that works. Even though I'm a licensed financial advisor. No, not that.
Go yourself. Is that clear?
There we go. All right. So anyway, this multivariate core is a big deal. The Fed definitely looks at this pretty clearly, and I think this is if you get any softness in a jobs report this Friday, and you get this kind of multivariate core, I think what you're basically telling the Fed is it might be time to start cutting now. So we'll see. I find that fascinating. You could find this pretty easily if you want to go look for it yourself. I personally recommend looking at it every few days. And you'll find it's just a multivariate core. It's spelled just like it sounds. And I think it's a great tool for paying attention to what's going on. Okay, so let's go see what else we have. We have, let's see, crypto. Oh, I want to see how BTC is doing today. So today, okay, so gold sitting at 2047, BTC 41,839, and a lot of enthusiasm about various different things. Yesterday, I actually did a video specifically on crypto and some really important catalyst dates for January that could actually end up delaying the crypto ETF a little bit. So if you haven't yet watched that video, I think it's a great one to watch. That's on the main channel, so you'll be able to see that. Okay, let's take a look at Mike Wilson's bear piece. I kind of enjoy looking at his bearishness. This is somewhat entertaining. So yeah, let's take a peek right here at the latest bear news. All right. One sec. Okay. There we go. All right, here's our good old Mike Wilson. Real estate warm-up. How low can rates go? The direction of the equity markets continues to be influenced by the rate change on bond yields. This is basically Mike Wilson saying, hey, yeah, I know stocks have been going up, but I swear it's only because rates have been going down. Okay, which have been dictated recently by the bond market's perception of future rate cuts, with 130 basis points of cuts now priced in through the year end of 2024. Okay, not entirely untrue. This is, we were just reading that 125 bips are priced in. And so the question now is, what is that going to do to markets if we don't end up getting this? Remember, it seems like every time we have to unwind Fed rate pricing, we have the market fall. Whereas if we're pricing in cuts, we have the market do substantially better. So, okay, makes sense. After a 20% drawdown in many stocks between July and October, equities staged an impressive rebound in November thanks to a sharp reversal in interest rates. Good proportion was due to pricing in the cuts. We held our recurring meeting with lead analysts across the U.S., across U.S. research and Morgan Stanley, and our economists to better connect macro and micro data points. We're still seeing consumer delinquencies accelerate, particularly in credit card. However, lower quality areas of lending have started to see delinquencies grow at a slower pace. Wow. That's actually really interesting because, I mean, that's basically screaming affirm for you right there. I find that very interesting. Because remember, that's always the big fear. The big fear is always if you're going to go into a recession, you're going to see the biggest pain where the defaults are, which makes logical sense. I guess you could say, fortunately, you've actually seen that this lower quality style of lending, I guess now, according to Mike Wilson, is becoming less bad. So the badness is getting less bad. Okay. REITs, office pricing should be down more than it is, but there are no deals to be done. So you're not getting price discovery, basically. Relatively stable demand thus far, but the year end is typically lumpy for holiday. This is hardline, broadline. Okay, this is retail. Holiday promotions. Staples, modest signs of consumer stress, but manageable, with only moderate brand trade down so far. You know, Walmart was complaining about this a little bit. We obviously saw their earnings call, and in their earnings call, they were really discussing this idea that, oh yeah, we're in an environment where Hold on one second. Let me plug this back in here. Let's take this little test here really quick. There we go. Okay, try that. Sometimes you just gotta unplug it and plug it back in again. That didn't solve my problem though. Okay, dang it. All right, so trade downs was something in 2022 that was regularly talked about, and people thought, okay, well, any kind of brand name stocks might potentially underperform. That was a big thesis there for a while. Of course, everybody's always got a thesis. Eventually it all plays out. Restaurants demand has been relatively stable. Media, 20+% streaming prices inflation across services, and we're not seeing a significant negative churn response. Tech hardware, PC market is seeing a down tick in Q4 after a strong Q3, Q2. Chemicals demand is tepid, but getting better. See, honestly, a lot of this doesn't sound that horrible, Mr. Morgan Stanley. 58% of consumers shopped during Black Friday, Cyber Monday, down from 63% last year. Well, that's really interesting because we were up in sales like, what, 7% according to Adobe this year. So you're up 7% in sales, but what you're saying is you actually had less people shopping. So less people were responsible for a larger portion of that sales increase. I mean, with a 5% drop at shoppers, though, you would have expected some more damage here. I mean, I certainly would have. 5% drop in shoppers. I thought, and I was sort of going into Black Friday thinking that, we'll probably only have an inflation-adjusted positive retail sales number. Or should I say, we'll only have a positive number because of inflation, right? So, like, yay, inflation's 4%, but sales for Black Friday were up 4.1. That was sort of my thinking going into it. That's not what we got. By getting a 7% beat, it was actually pretty impressive. Apparel is the top category purchased. Wow. Yeah, that explains a lot of the clothing stocks are just absolutely crushing it. No, the 7% retail sales number is not inflation adjusted. Yeah. iPhone microphone made Kevin sound like Mike Tyson. All right, let's take a sip of this coffee here. Good old Bowser mug over here. All right, let me try something here. Really? Oh, hold on a sec. I think I might have a way to solve a little oopsie doopsies here. I think I figured it out. Hold on. What is this? Give me 1 second. All right.
Fantastic. It's fantastic stuff.
All right.
I put my wife.
That sounds good. Now I got a little bit of sound back. Okay, let's see if I can get that right here.
This stuff. Let's use this.
Yay! Yay! I have fixed all of the problems live. I can't stand that. It's like try so hard to have it perfect, but life isn't perfect. But it's frustrating when it happens, while you're in the middle of trying to actually present. And then you're the one-man studio. But it's okay. We have fixed it. We can now listen to Jim Cramer. And here's what Jim Cramer has to say. I did that on purpose. He has nothing to say. Okay, so back to this. Oh, that was mean, Kevin. Okay. All right. So 38% of survey respondents said Black Friday promotions were worse than last year. Okay, interesting. 38% of survey respondents. Oh, I was reading something really interesting about surveys in the Financial Times. This was so fascinating. Apparently, it is much more common leading up to an election to basically have people purposefully bag on the economic surveys because they hate the president so much. So think about that for a moment. If you're a Republican, you probably hate Biden. Or at least you don't want him to be your president. Probably. I guess I shouldn't guarantee that because I'm sure there are some I guess in some world, there are some Republicans who might actually want Biden. But anyway, so then if you're a Democrat, you may be like, well, I'll take Biden over my other choices, right? That's generally what I'm hearing. I'm, again, painting with a broad brush here. But I was reading in the Financial Times that people are actually sandbagging the economic sentiment surveys. And they do this during good times as well, except more people actually feel good. So for example, like put it this way. Let's say on an average market, like it's 2013 to 2019, okay? 2013 to 2019, like sentiment on average is here. But, you know, when Obama's president, Republicans bagged the surveys. And when Trump's president, Democrats, you know, bagged the surveys. So basically, you just say, like, everything's bad. Everything sucks. Business sucks. Optimism sucks. Inflation expectations really high. So you basically purposely sandbag the surveys so you could try to put pressure on the president. You know, favorability, hate his guts, you know, whatever. It's just sort of a way of, like, political voting without voting. So you sandbag the survey. Like, one party always sandbags the survey. But when you're in a recessionary time, the baseline survey is already lower. So the sandbagging has even more of an impact of how bad the surveys actually come in. That's a thesis. And I will say, I love that kind of perspective because I would have never thought about that. I don't know if it's true. Neither do they, because it's surveys. I mean, surveys are like, which way is the wind blowing today? You know? So anyway. All right. Let's see what we have over here. 13% said the sales were better. That's interesting. Only 13% thought the sales were better. You know, there was that viral Target disaster where basically the Black Friday pricing was the same as what they had last or right before Black Friday. That I thought was really interesting. Let me, I'm going to pull that here. Let's see if I can find that. Target, just in case you hadn't seen that. Black Friday, which I'm pretty sure is against the law. But it was, oh yeah, it's so viral. Oh yeah, okay. Ready for this? Look at this. Yeah, see, the person has basically the Black Friday deal card right here. And then they pull this card out behind it, and it says sale, and it's the same price. Somebody here says, you don't need a weatherman to know which way the wind is blowing. That's right. You just need a sock puppet. Look at that. Same thing over here at Target as well. Rip. You know, I never knew what a sock puppet was until I started learning a little bit more about aviation. I guess it's that orange flag that you know, the more straight it is, the more, I guess, or the higher the wind speeds are. Yeah, and then obviously it tells you direction as well and can kind of let you know when a gust is coming in or whatever, which I always thought that was really interesting, how the sock puppet knows that a gust is coming before you do. You know, what if you're on the side the wind is coming from? Is there another sock puppet? I don't know. Wind sock? Sock puppet. Sock puppet. Okay, maybe it's a windsock. Whatever. Then I was wrong. All right, so next. Only 16% of holiday shoppers say they are done with their holiday shopping. Okay. Over half of consumers are planning to travel over the next 6 months, slightly higher than last time. Despite cooling inflation, consumers are still worried about rising prices. 63% of consumers say their primary concern is inflation. You know, what's interesting is this did not go away until 1985, after you had the Paul Volckering. So think about that kind of pain. It took until 1985 for consumers to actually feel like, wow, okay, inflation's actually going away. That's wild, because that means it took 3 years after the Volckering. Well, that means 2025. So think about it. I mean, the numbers actually line up eerily similar. Okay, 82, you get the Volckering. 82, you get the Volckering. And then 1985, less, consumers feel less inflation, right? So if you align that, you could say 2022 and 2025. Ooh, how eerie are those numbers? A sock puppet is a false online identity used for deceptive purposes. Okay, I got it wrong. How low can rates go? After a challenging 3-month stretch for stocks, November recouped all of its losses. Well, not for Tesla. Oh, we're in phase. Oh, although Intel's doing well. Well, it was until it dropped like 3% yesterday. Oh. On Friday, the equity market took a slightly different complexion with small caps and lower quality outperforming in a way we haven't witnessed much this year. That is true. Despite Jay Powell's comments that it was premature to price in cuts, the bond market went ahead and priced in an even greater chance of cuts. Yeah, that sounds like a Mike Wilson article. Swings in market pricing of the Fed policy next year have had a major impact on both bonds and stocks this year. What duh. Okay. In our view, the Fed pivot has now been priced in multiple times over the past year, with the latest pricing gaining support from investors, many of whom see the pivot playing out amid a still healthy macro backdrop, which would be the most bullish outcome for equities. This is true. And right here, he's kind of suggesting that the base case is basically a base bullishness, which, if you're contrarian, is actually not good. Dude, look at this icon. This is Andre's icon here. Dr. Andre, it looks like. Has that icon almost looks 3D. Like it looks like your face is like popping out of that. Farmer Brett, that's a cool icon too. But this one looks like it's popping out. All right. The cycle in peak in the in front end rates is typically bullish. For equities. Okay, I want to see what Mike Wilson actually thinks is going to happen. On the other hand, if inflation proves to be sticky despite slowing growth, the Fed typically maintains a restrictive policy until later in the cycle, only cutting when growth backdrop deteriorates significantly. Over the past year, the equity market has sent the message that it expects the former scenario to play out. The former scenario would be the basically the soft landing scenario. Okay. We offer an alternative look at our prior analysis on equity returns. Here we go. Note the strong disparity in performance between cycles where inflation was historically elevated. Okay, let's see. I want to see his chart. All right, so what do we have right here? Ooh, look at that. All right. S&P 500 returns post-cycle peak. Okay, interesting chart here. We're looking at post-cycle peak. So post-cycle, so after the peak, which could have been had in July. So let's say the Fed peak was July. The inflation not elevated scenario would say your 3-month return has been positive. I don't think so. Your 6-month return has been positive, probably. 9-month, probably, yeah. 12-month, I guess TBD. We're still waiting for the 9 and 12 to play out. Okay. However, if inflation remains elevated, you would expect to be negative. I don't know how useful this is, though, because some of these years were very interesting. 1981 was the Paul Volcker ring, leading into 1982. It's like August 81, early 82. And then 73, we had just been out of the gold standard for a bit, and we had to get we had to start unwinding some of the price caps that were going on. It was a tough time. The 70s were a disaster in terms of inflation and pricing. As noted, we remain of the view that we are in a late cycle regime rather than a mid or early cycle. This is very Ray Dalio-esque. The debt cycle is going to take over. Employment trends today look inconsistent with the prior mid-cycle. Conference Board employment trend. Basically here arguing that, it is interesting. Look at that. Mid-cycle slowdowns are pretty flat right here on this blue line, which is the Conference Board's employment trend. Yeah, look at those mid-cycle pauses there. You've got much more of an actual trend down. But then it makes you wonder, do you have to fall off a cliff, or could you cut it a soft landing? I don't know. The prior drops in the consumer conference board, they all look pretty steep. Exception of 82. Hold on a sec. Look at 82 right here. Here's your 82 drop. And you kind of dropped, what, 8 basis points? And what do we have over here? Almost a similar kind of drop. Probably has to end somewhere around there. That's interesting. Yeah, a lot of people think this is the start of the new cycle. We'll see. Earnings revision breadth. This is a common chart we've seen from Mike Wilson. All right. What's his bottom line? Another topic of interest has been the presidential elections. Yeah, we know. All right. Commercial real estate outlook. We talked about that in the intro. Not seeing a lot of the price discovery. REITs down 10%, but not much more than that. A lot of this was in the intro. What are consumers telling us? I always think this is interesting when you get some of these charts over here. Holiday spending by category. I love seeing this. Love seeing what people are spending on now compared to previously. And let's go get another market update after this. So look at this. You have planned to spend on holiday products / gifts this year versus last. And versus last by category. Expect to spend less is green. So the biggest less section here is home and kitchen, followed by consumer electronics. And the expect to spend more category, that's the largest. That's what we're seeing in the earnings. Clothing and apparel. It's not highlighting gift cards here. Clothing. Yeah. And toys. Oh, interesting. 19% for toys. Huh. Luxury goods. Leaning more heavily on the spend less side. Fascinating. Rising prices among holiday shoppers. Is it impacting you? Some impact. I will buy less. Looks like you're looking at about 43%. Significant impact. 34%. I will buy a lot less. People say that though. Again, I wonder how much of that is protest. Let's see what they're interested in buying. So, the same stocks. They've been chilling for a while. Okay. So that would be Coca-Cola. And Coca-Cola has been on a little bit of a rebound. There is not a poorly performing stock at all. It never really has been. I mean, since here it is since the pandemic. And you've got your volatility, but it's coming off that 200-day moving average. Let's look at Mickey D's. How's Mickey D's doing? MCD. Wow, look at Mickey D's. Also just really staying above that 100-day moving average. Anytime Mickey D's drops below that 100-day moving average, it's a buy. And you could almost set a bot to that. Just buy McDonald's every time it's under the 100-day moving average. That would be an interesting trading bot. Look at that. When it's between the 100 and the 200-day moving average, pretty juice spot. Of course, will next time be different? Oh, dear. All right. So then we've got Mondelez. MDLZ. MDLZ. Mondelez. This is the week chart again. So remember, you're going all the way back to, COVID over here. Let's go to the day chart to see a little more recent. Yeah, nice recovery as well, though. You really did have a little bit of a crash here in October, but still not a bad recovery. And Verizon and Walmart. Here's Verizon, also a nice recovery in November. Everything feels like it recovered in November. Walmart down. Ooh, Walmart under the 200-day moving average. Wow. Last time we hit the 200-day moving average was in March of 2023. You broke it in about August, September of 2022. And of course, during COVID. Wow. All right. Good piece from Mr. Morgan Stanley here. All right, let's look at the 5-year break even and how yields are doing as we're going into the open. Okay, Wells Fargo CEO warns of severance costs of $1 billion in Q4 as layoffs loom. Here we go. All right. 5-year break even. It should be down with that multivariate dropping. I keep spelling it wrong. Here we go. There we go. Okay, 5-year break even. Ooh, we're almost at the absolute lowest level we've seen this year. And that's juicy. A nice little plummet down at 2.14 on the 5-year break even. And if I go for the 5-year forward, let's find out. 2.24. Still on that uptrend for 2024, but it's definitely down off its peaks. All right, pre-market here. Tesla down 88 bips, Nvidia down 84. You know what we might do today is I just want to cover the JOLTS. Ideally, we can cover that live. So let's get into JOLTS comes out at 7. So I'm going to set the course live today for 7:05. We'll go course live December 5. Yeah, I mean, if data comes up there, we cover it. But usually we're much more focused on analysis there, whether it's real estate or stock analysis. So we'll set that for 7:05. All right, very well. So let's now see. Yeah, oh, and then actually in about 20 minutes, we're going to get the S&P Services and Composite PMIs, Purchaser Manager Index survey. And then as well as the JOLT survey, you'll get prices paid on ISM. People like paying attention to that one. Okay, good. So next up, let's see what the suits are saying. Traders will find no non-farm payroll clue in this week's labor report. Oh, that's interesting. Markets shouldn't put too much weight on the 2 key labor reports ahead of Friday's non-farm payrolls, as none of the two are a good indicator for the latter. Ooh. The JOLT survey, which comes out at 7 a.m. Pacific time, is expected to show a drop to 9.3 million from 9.6 in the prior, but the data is for October, a month where payrolls saw a big miss. It will tell us nothing about November other than offering more evidence of slowing labor. Yeah, well, how is the stock market going to react? Traders would hope that tomorrow's ADP numbers might offer more clues, but that has become a poor indicator of non-farm payroll, which with its correlation actually turning negative over the last year. Oh, wow, that's crazy. Yeah, its correlation is negative 0.45. So it's almost like when you have a negative correlation, you're basically almost suggesting that the opposite happens of whatever ADP says. Oh, that's kind of funny. All right, let's listen to CBC for a moment.
You're saying, okay, I guess you're right.
Look at Lulu kill it. It's that clothing sector. What a surprise.
David, if an inline guide, you get to buy it lower.
Or you're happy you sold right here.
Well, I just think that when you have 2 pieces in a row, people are going to say somebody knows something.
Right. Which
That's all.
isn't necessarily the case.
No, but that's what people say.
Although you make an important point, which is sometimes companies will whisper to analysts who will lower their numbers going into a quarter end quietly.
Say, listen, we're not going to be as boisterous as you'd
Right.
like.
Right. And then you've got estimates that are lower that you can then beat.
Exactly.
But
You
of course,
just
it's not
described
really a beat.
You just described what people are paid billions of dollars to do.
Well, we've been seeing that game.
Yeah. Rig the estimates. That makes a lot of sense. Gamesmanship. But that's going to happen in every market. So, all right, a Fed rate cut pricing will soon need a recession to be justified. The depth of expected rate cuts from the Fed is close to being consistent with a recession. Ooh. If contraction is on the cards, unlikely in the near term, stocks and credit are mispriced. Otherwise, short-term rates now look almost too low for a soft landing scenario. Markets love pushing things to their limits. Soft landing expectations combined with the Fed speak that for the first time we saw, let's see, expectations. Well, I don't know about that. Okay, here we go. But we are at the point where it would be almost unprecedented for the expected amount of cuts to be delivered unless a recession is imminent. Wow. That's a big line. All right, let's see what we got here. Large Fed rate cuts are typically recessionary when they come. That should be able to pull up so we can see that together. Let's move. Okay, here we go. So that's been my problem. Okay, move this here. And then they'll pop up. Okay. Fixing all our problems today. All right, let's take a look at that. I want to show you the chart that they're referring to today. Oh, JK. It has not synced yet. Okay, keep reading. I don't view an NBER recession as imminent, and the downturn is likely delayed until mid next year at the earliest, mid 24. But if the rates market is correct, a recession is on its way. Then stocks and credit markets might not have gotten a message, with the S&P 500 only 5% off its all-time high. Yeah, that would make sense. All right. Nope, I guess I still can't get that to come over. Oh. Bummer. I totally should. Okay. All right, well, I'll keep trying on that. I want to show the screenshots, but today I have a screenshot problem. Yeah. All right. Oh, well. So, basically, I'll just describe it. We'll figure it out. So, describing this, large Fed rate cuts are typically recessionary. The one-year change of Fed rate cuts, the only significant time we had rate cuts outside of a recession was in 1985 and 6. Otherwise, you had 1991 recession. Well, I mean, Fed rate cuts. Yeah, I guess you were still going up in 95. You were just going up at a slower pace. Cuts in 2003, cuts in 2009, cuts obviously during COVID. Oh, that is interesting. Let's listen in here for a moment.
Trends with robust competitive growth of 5 to 6%. And importantly, this is the beginning of a cycle of growth with growth which will be top tier in the second half of the decade of 5 to 7%. So this is all based on the strength of our portfolio and on our pipeline.
That's J&J's chief, Joaquin Duato, on Squawk earlier today. Sales guide for 24, Jim. So
yeah, well, you can
therapies, products.
Look, I've got to tell you, to me, the greatest thing was they give you a roadmap to the next decade. And they're doing it because they have 10 new drugs that can do $5 billion each. That's pretty incredible. 15 that can do $1 to $5 billion. That's just a very strong product portfolio. David, you know these trade on pipeline. And the pipeline here is solid. So
they false started that bell so hardcore there.
the overhang of talc. There is.
I think maybe they're testing. That's it. They're practicing. They're warming up. We'll go with that.
You're on the stock. That's so great.
No, but it's a lid. It's a lid that's caused by litigation. It's a litigation lid. It really is.
Right.
And right now, I know that they said that one of the things that's so hard about changing, they said, listen, they strongly hope to fix the problem for it. But that's not up to them. It's up to the plaintiffs' bar whether they want to deal or not. Because the court system and where they are in the Third Circuit favors the plaintiffs, not the defendant, Johnson & Johnson.
Watch J&J hanging on some gains in the pre-market. Let's get that opening bell and the CNBC real-time exchange of the big board. It is Johnson & Johnson with the NASDAQ. Evolve ETFs, a Canadian ETF provider. Some soothing comments from B of A today about December historically, Jim, which is the best month of the year.
I just love that piece. And they basically just remind you that it's not a myth, the Santa Claus rally. Top
It's not a
year.
myth, the Santa Claus rally. The last 2 years, it hasn't been. 2021 was not a Santa Claus rally. 2022 was not a Santa Claus rally. Both of those years, you had a horrible Santa Claus. You got coal for Christmas. It was bad. Bitcoin at 42.1 right now. A little bit of a pump here. We've got, okay. I mean, I'm not going to say no to the green candlestick there. Tesla's got a green candlestick. You've got NVIDIA trying to go green. You've got the Qs as a result trying to go green. Let's see if it actually sticks. You've got AMD 117 dropping. Bill.com all of a sudden up 4%, carrying over from the pre-market. Roblox still at 40. Roblox is the still at 40 stock like forever. I feel like this stock is always here. Yeah, it's just always sitting here. You could almost just draw a little channel for it. Some kind of nice, generic, downward trend here. Let's go grab another one. There we go. You're almost a shelf right here, honestly. Yeah, I might just go horizontal on this one. Just keep it simple. Ooh, I like that one. See, I'm not taking the wicks. I'm going to go for the real candle here. If I go for the real candle on these, probably a little lower. No, that one's not as good. It's not as tight. No, I'm going to go back to the tips. Tips. Touch the tips. Something like that. There we go. Let's throw in a different color there so it contrasts with your fibbies. There you go. Roblox. When's it going to break out of this? Hey, that could be a moment. Speaking of breakout, let's see if Enphase is holding on to its breakout. No. So for Enphase to hold today, it just needs to close. Let's see here. Go to the day chart. We really need to close. Oh, okay. You really only have to close above, 102. So that's not bad. Yeah. A lot of people talking about Palantir. Back to 18%. It's some volatility in software. It's not a surprise with the Qs coming down. Enphase almost down 1%. Qs, how are we doing on Qs? Are we still trying to recover? Still trying to. Oh, all right. We'll keep an eye on that. All right. More news. So remember, I'm gonna put a little tag down here. We're gonna say JOLTS at 7 a.m. That's Pacific time. Yeah, that's California time. I am. It's so interesting to me how the weirdest irony could end up being true, but I'm seeing this more and more. I'm seeing rents fall, and I've been seeing rents fall in a lot of COVID markets, especially like the COVID boomtown markets. Like I remember I flew to Arizona in but pretty much every month I feel like of this year. Maybe not within the last few months here, but no, actually I was there not that long ago. But anyway, I've been to Arizona a lot. And so, and what I saw in January, and I'm pretty sure we made a video on this, but anyway, what I saw in January was not rent cuts, but rental concessions, which is basically the same thing. You just have to do the math. And they're basically taking off $200 a month off the rent by offering people, a free month of rent. And I didn't see that yet in other markets, like the non-COVID boomtown markets, like California. And sure enough, now the data is showing that, rents have been falling quite a bit in a place like Arizona, and you're not getting that kind of fall. I mean, you are getting a broad softening of year-over-year rents across the entire United States. Mostly, there are very few markets that are positive on rent. Maybe Miami, but some people argue that that's because of some gentrifying that's going on just outside of the downtown. You go outside of Brickell, it needs it needs some love. It's it gets a little harder to collect probably. But anyway, so you get a lot of speculators coming in, tearing down old properties and turning them into little mansions because they're so close to downtown. And so that could be driving some of the rents up in Miami specifically. But otherwise, you're seeing a little bit of a rent softening, especially in those COVID boom towns, which you're not seeing as much in markets where it's harder to build, like California. So they make it harder to build, which is annoying because you want to make housing more affordable for people, but California kind of gets in the way of itself. All right. Let's listen over here. Ooh, another little green candle there, right as I was about to click away there on the cues.
Chat is, plaything. I think chat's great.
ChatGPT.
I think it's fantastic. I mean, you can ask it stuff, and it's just smarter than you.
Well, now we got Meta and IBM creating this coalition of AI companies who want an open source model, unlike Chat and unlike Google.
Right, and that can happen. I don't know. I mean, IBM stock, by the way, it's just been a horse. So I'm reluctant to say that they don't have something good.
Look at Apple. Nice little jump here on Apple. That should drive our indices up. Let's take a look at. Oh, Tesla's up 1% too. Look at that rocket, baby. Let's go.
Just close the fucking door. Close the door.
You've got Nvidia trying to stay green here, bobbing around. Ooh, a firm with the 37. Wow. Look at that run on a firm. I'm going to go for the average or the normal candlestick for a moment. Oops. Yesterday, 2%, 9% before that, 0.85, 4.1, 11. Look how fast you could just reprice stocks. It's really incredible. Yeah, Enphase still bobbing around over here. All right, we'll watch that. Okay. So we are now 23 minutes away from the JOLTS data. Let's listen in here for a moment.
Go by J&J. I mean, I'm not doing that. I used to do that when I was at Goldman and be like, my boss would say, Jim, did you really recommend to someone who's a billionaire to go buy some J&J? He said, you only need to get rich once. And you're like, think about what happens if J&J goes down. I said, yeah, you're right.
What about your friend Jensen? Would you advise him then to also diversify and potentially sell?
I don't think there's any, no, I'm saying I don't think there's anything wrong with Jensen doing some selling.
Right.
And not because of what Gina Raimondo said.
And Bezos, of course, has been doing a little bit of selling, very little.
Well, I like these guys. There's a lot of guys who sell $7 million and they buy a place in Florida. It's always 7. What is that about?
No, well, 7. I mean, not for Bezos doesn't set. I mean, it's hundreds of millions.
You're right.
Hundreds.
I don't want to insult Bezos. I'm just saying
$7 million is not going to get you anything. It won't even get you into Palm Beach. You won't even get you the parking garage.
All right. Okay, so let's see here. Yeah, it does look like things are going a little green right now. I want to understand the bond market. We've got, 4.2. Let's go, 420. Okay, all right. We've got, we're at down about 8 basis points. This JOLTS data, come on, let's see it. NEO jumped about 4%. Looks like it looks like NEO's earnings came out. Let's take a look at their earnings quickly. So NEO, ADRs, financial news. Let's see what we got on NEO here. So wow, BYD growth status in question with $12 billion sell-off. That's BYD. Oh, interesting. Well, I want to look at that really quick. Everybody's been raving about BYD. BYD doubts over BYD's sales targets and smart car capabilities drove a $12 billion sell-off in the EV car maker last month, even as it draws closer to Tesla as the industry's top seller. Hong Kong listed BYD plunged 12% in November, while Tesla and Xpeng gained more than 15% each. BYD's loss was fueled by concerns over its ability to meet sales targets amid difficult macro outlook. Well, yeah, I mean, tough. Okay. BYD shares actually outperformed in October, though. Interest rate headwinds. Founded in 1995 with a focus on batteries, BYD is strong in power technology. Smaller, younger peers like Xpeng and Li Auto, in contrast, have put resources into software. Yeah, BYD is less concerned about full self-driving or some of those longer-term innovations, which could be a little oopsie doopsie for them, honestly. They might want to reconsider that. Then you've got, so Neo comes in with gross margin of 8%. All right. Let me write this down. Okay, there we go. Drop that in. Perfect. Okay, so you've got Neo drops 3.8% as Q3 revenue misses. Okay, well, then I must have started going up a little early after that. But anyway, Q4 deliveries are expected to be about 48,000. The estimate was 59,000. That doesn't sound like a great beat. So you did have a little bit of a miss, but they're saying the miss narrowed. All right, let's see how it's actually moving. Neo stock right now. Oh, yep, no, it was up 4%. Now we're getting some of those red candlesticks. Still up about 3.5% here. 1.5 to the downside on end phase. Tesla's up about 0.86. Apple's up about 1.72. Nvidia's flat. TMF. Okay, TMF is going to be a little bit of a different one, difficult. Well, there we go. Just look at the chart. Look at TMF. So this is a 3x leverage bond DTF. I own this sucker. Unfortunately for me, I bought this sucker probably where we are now. Well, actually, I think I can tell you. I bought it. Yeah, actually, probably. Was it when it was at 4.3? Yeah, it was when I was at 4.3 I bought it. About 9.14. 9.14. Is that right? Oh, that's a bummer. Yeah, right about there. Well, I guess that means I just went positive on that sucker. On the actual basis of where the underlying position is. TMF is interesting though, because I wouldn't be surprised. Like if we've hit peak, that sucker's at bottom. Now you have to be careful. You have to be careful with this because it is it's a leveraged ETF. These are not good tools to hold on to long term. There's serious suitability questions here. But look at that chart, okay? And my purchase on this sucker was basically right there. See where that sort of line is that I've made? So I have to say, looking at the chart, that doesn't look too damn miserable. But I think that upside could be pretty glorious if rates end up going, low again. We start fighting deflation and we get to you basically probably, you could get up to this like nearly 4x level, 4 to 5x level on TMF. Very dangerous though, again, because it's leveraged. So you get hit with the fees a little harder as well. And there's always it's harder to recover when you have leveraged losses to the downside. So keep all that in mind. But that's an interesting one. Down 8.3% on the 10 right now. Oh, let's look at the 2-year. And then remember, JOLTS is coming out at 17 minutes. 2-year right now is down at 4.62. So still about 42 basis points inverted. The 10-year falling more than the 2-year. 10 years down 8. 2 years down 4. It's supposed to be the other way around. So a little more concern about the economy, in other words. Okay, BlackRock now warning about optimism over rate cuts, suggesting there's too much optimism. Okay, they must be short and upset. While some traders are positioning for the Federal Reserve to start cutting rates as soon as the first quarter, BlackRock strategists expect the easing will only begin after the middle of the year. We see the risks of these hopes of quick rate cuts being disappointed. I guess we'll find out. All right, 16 minutes away. Let's hit the cues. Okay, got a recovery going on over here on the NASDAQ. All right, we'll take it. We'll take it. We've got Blocksphere. The answer is both. Oh, S&P Global data out. Here we go. 50.7 versus the 50.7 expected. 50.8 versus the 50.8 expected. A match on expectations. Wow. Usually you start getting matches more on expectations when the economy actually stabilizes, which is really annoying because it means the time you need the data most, it's least reliable. Think about that for a moment. Did any of you give a flying F about the JOLTS survey in 2016? No, of course not. Because, like, were we really worried about anything in 2016 other than, well, I mean, we did have a Hillary versus Trump election, but let's cut the politics out. People have made it exceptionally clear to me to just not talk about politics. So we do touch on it in the podcast. We had a great podcast yesterday. But honestly, we spent most of the time just talking about the Cybertruck. So I'm trying to listen to the feedback. I promise. Hopefully you've also liked the change in the style of the videos on the main channel a little bit. You like the reliability now of the course, or the stock market open live stream every day, 5:25. We're here doing this usually up until right about now. However, because the JOLTS survey is coming out, we're just going to go a little bit longer, about an extra 20 minutes here, just so we can cover JOLTS. So, yep. All right. I think Alan here is projecting some insecurities. He says, "Stop lying." That's my feedback. You know, Alan, when you point a finger, 3 fingers point back at yourself. So what are you lying about? Huh, Step Bro, you stuck? You need to get unstuck? You need me to come over there? You stuck in the dishwasher? Oh, man. All right. Let's see what we got. Okay, they're reviewing that. We already covered this.
The composite PMI at 50.7. It's the second month in a row at 50.
Bro, Alan, I've been talking about when I actually bought TMF. Since I actually bought TMF. So take the stick out of your butt. Just because you weren't here when you heard me say it is not my problem.
Half of the hour, along with ISM services PMIs, as we continue to monitor the service sector. Even though it seems to be slowing, not at its best levels, it still remains in expansion territory. Squawk on the Street will return after a short break.
All right. So, no, nothing really out of that. Again, JOLTS now in 13 minutes. 13 minutes to JOLTS. We are looking at Tesla's holding on here about 1%. Somebody here says, Kevin, why are you never on CNBC? You know, I had a little CNBC special. If you just type into YouTube, meet Kevin, what was it? What did they call it? CNBC Make It. Yeah. So then we've got, what is this? Kevin, you always talk about San Diego. Any thoughts on the North County area? I hear you speak about Chula, but never coastal North County towns. California is just awesome. You know, Chula's still more developing. Chula's developing, but you look at like Irvine, Tustin, Anaheim, Buena Park. These areas are blowing up, man. You've got like tech going in over there. Like you're basically Silicon Beach over there. It's a beautiful place to live. You don't have the Los Angeles, you know, nonsense. You don't have the San Francisco nonsense. You know, that's the stuff that makes the news. But you know, that's not all of California. So I don't know, but it's just popular to hate on it. It's kind of funny. Okay, so well, yeah, all right. We are now 11 minutes away. 11 minutes away from the announcement. The announcement of the good old JOLTS survey. So let's go and take a look here. We are looking at 9.3 million is the expectation, and 9.6 million is the actually 9.55 is the prior read, or was the prior read. So we'll see what we get. You know, we did drop below 9 for a while there. We dropped down to about 8.7 million. So we'll buckle up for that. Okay, let's see. I'm gonna see if I can pull another. See if we can get another bear piece from the suits over here. I always like the bear pieces. We got 10 minutes. it's probably a good opportunity to explore some more of the bearishness here. Let's see here. So let's go jump into the read for today. So we got Morgan Stanley. We covered that. Bank of America. Did central banks overhike? Ooh. Ooh. Okay, here we go. So now we're going to go save. There we go. Open. All right. Let's press this button. Some analysts argue. Ooh, here we go. Who's ready for this? I don't know. Do we? How much do we care about what Bank of America has to say? Well, I think we should look at it. You know, I'm a big fan of looking at whatever kind of perspective I can, mostly because it's something that I mean, you never know what somebody's perspective is going to be. So let's find out. Okay. Given the transitory nature of shocks that drove spikes in deflation. Ooh, wait, what? Hold on a sec. Given the transitory nature of the shocks that drove the spikes in inflation. Okay, yeah. Okay, I'll read this correctly. And the long term, so now they're like trying to definitely define it as transitory. That's interesting. Okay. And the long-term inflation expectations and that long-term inflation expectations remain anchored. Central banks in developed economies could have refrained from hiking interest rates as much. The argument goes that central banks like the Fed and ECB overhiked. Inflation expectations are endogenous. Oh man, I haven't looked at that word in a while. Looking at let's see what they're saying here. Looking at the path of monetary policy for the Fed and the ECB, as well as respective measures of inflation expectations, shows that monetary policy was late to react to inflationary pressures. We know that. And while causality cannot be established, it was only after monetary tightening took place that inflation expectations started to reverse. Of course, many would argue that inflationary policy should not react to supply shocks, or that inflation expectations would have fallen by themselves after inflation shocks disappeared, or after the shocks disappeared. Okay, fine. It's debatable if the Fed or ECB overhiked. In fact, our Euro area economists believe the ECB has overhiked, but the stability of inflation expectations, regardless of the horizon used, is not a sufficient statistic to conclude that it was the case. Okay, so in other words, just because inflation expectations are stable, we can't guarantee that the Federal Reserve overhiked. Fine. Okay. So what do we have here? Fed funds rate is, let's try to align this a little bit. Fed funds rate is right here. Okay, that doesn't help to draw a blue line. Let's try green line. There we go. There's the Fed funds rate. And then we have 1 year inflation expectations. Look at that spike in inflation expectations right here. You really see that spike in inflation expectations. Pretty actually accurate, a year ahead. How interesting. 1 year ahead inflation expectations really rose. Took about a year for us to really see that. Wait, is that true? Hold on. Inflation expectations started rising over here in late 21. Well, by mid-22, we had pretty high inflation already. But mid-22 would have been over here. Yeah, that's not bad. Expectations weren't necessarily wrong. All right, some commentary on ISMs and otherwise. But sounds to me like they're basically saying, no, we can't really say that they did. All right. Why even write a piece then? All right, I'll grab another one. Let's listen in here for a second.
There was a statement from Hanhai, which we know as Foxconn, saying that it generated the second highest November sales total in 2023, according to 18% year over year. Now, that would mean, because they're Apple assembler, that Apple has got a lot of orders. Now, that's contrary to almost everything that you read. But I tend to believe that just because there's availability doesn't mean it's the end of the world. It may mean that they're very smart about inventory. So it's a double-edged sword. I'm going to go with Foxconn and big business Apple.
It's a 4-month high here on Apple.
Yep. I mean, look, I was going to go with Smucker, which was Mark was on this morning, and people are saying that's the bottom in GLP. There's a lot of very interesting bottom callings, but I like this Apple. You know that I'm going to own it, don't trade it. And Dave, it's not just because of my affinity plan.
Not right, I understand.
But I still think
I
it's
know. The Han High news probably is what was pushing.
I mean, like substantive as opposed to my anecdotal.
Yes,
right?
correct.
It's empirical. I'm
Correct.
anecdotal.
That's yes.
While we wait for JOLTS in about 5 minutes, here is take a look at this rates outlook. Major central banks will continue to slowly shrink. Gotta love shrink. Hold on a second. Let me save that here really quick. All right. Open. There we go. All right. Major central banks will continue to slowly shrink their balance sheets. Okay, we know that. Meanwhile, U.S. public sector net issuance will continue to grow, basically more spending by the government. For 2024, the outlook for inflation remains central. Barring an accident, rate cuts should take longer to materialize. Hey, this is kind of what who was it? BlackRock. BlackRock just said the same thing. BlackRock just said this too. Yeah. Take a look at this. 3 minutes to JOLTS data. Though the process of QT, central bank reserve, or through the process of QT, central bank reserves have now a negative growth rate, led by deficits of other countries, foremost the U.S. Public sector debt continues to grow with strong positive growth rates, whose scale is unusual during an expansionary phase. This, we think, is a critical feature in the cycle. From a conceptual perspective, the rate of increase in the public sector has been more than twice the rate of attrition of central bank reserves. The rate of attrition. Okay, this is saying us basically vacuuming up money. Wait, this is a critical feature in the cycle. From a conceptual perspective, the rate of increase. Oh, wait, no. We're spending twice as much money as we're vacuuming up. Oh my gosh. That's like, I don't know what to make of that. I mean, it's bad for fiscal sustainability, but is it potentially good for the economy? I know you don't really want to rely on the government. Oh my gosh, Alan's still, dude, Alan is still going about the TMF thing. Bro, Alan, I'm not sitting here with what my exact trades are. I'm talking live. That's somewhere around 4.2%. I went long on TMF. I think I'm in the black. I don't know, bro. Chill, man. God. Like I look over, it's like Alan. And people like debating it. It's like, who cares? The point is, it's going up. For the Eurozone, the decision to run persistently large deficits puts credit ratings under potential pressure as the stock of debt grows for the Eurozone. Well, the Eurozone's also more likely to be in recession. I mean, you just had 2 quarters in a row of like negative 0.1 GDP over in Germany. Germany, remember, it is a manufacturing economy that exports deflation to America. That's a big deal because it makes things cheaper for us. Now, we don't want deflation. We do not want deflation. Deflation is worse than inflation. That's a hill that's a lot easier to die on than some other things. Now, I've seen recently some people put YouTube videos together and they're like, oh, we want deflation. That's good because prices come down. Bro, we had a depression in the early 1920s when we had deflation. We had a depression, not a recession. We had a depression. We had a depression in the Great Depression when we had deflation. During the Great Recession, when we had negative CPI, with mass unemployment. You don't want to go through that pain. I know everybody's like, well, then I'll be able to buy stuff cheaper. You ain't buying jack S when you don't have a job. So, I don't know, man. Like, begging for deflation is not what you want. Deflationary reports on CPI are like, okay, J-Pow, please.
Just close
please.
the fucking door. Close the door.
Turn the money printer back on. Oh, here we go. Oh, yes, 8.7. That's weakening, right? But that's a good sign that the Fed's gonna be done. 8.7. What did I say? We got to get under 9. I said it. We got to get under 9 again. Now that's good and bad, right? It's good because it tells the Fed, stop, enough. We're getting into balance alone. Okay, that's good. It's bad potentially if it keeps falling rapidly, but 8.7 isn't a bad number. That's a good read. I like it. That's a good read. That's good. I'll take it. What are the stocks doing? Okay. We got the green candles. Let's go. Yes. Green candle on Tesla. Okay. Here we go.
Close the fucking door. Close the door.
Yes. Okay. Then we've got, here we go. There it is. Look at that. QQQ popping off.
Yourself. Is that clear?
Let's go. Okay. So again, last read 9.5. We were expecting 9.3. I said if we get a number under 9, that's good. Like we want to get back under 9 because that's where we previously were. Like this is not a big surprise. The problem is one of the reasons we had this 3-month sell-off is because the number of JOLTS ran back over to over 9 million job openings. We wanted that number to come into more balance. The number is now officially coming into more balance. So let's freaking go. Finally, inflation numbers, multivariate core plummeting. Here we go. TMF, let's go. Bond yields just shaved another 3 basis points off the 10-year. Let's go. Finally, it could feel good when this data comes in good. I like that. We got to cheer that because we don't have enough of these. Didn't have enough of these days over the last 18 months. I'm tired of the bullshit red. It gets everybody cranky. You know, you start getting Allens in the chat. You know, everybody starts getting a little fussy. We got to get into the, let's get back into the positive.
The lead.
Yeah. So, okay. All right. This is fantastic. I want to see some more of the reaction. I want to see the suits reaction. Let's see here. Okay. So let's see what the suits are saying here. Some people in the chat saying soft landing coming. Okay. No actual commentary yet from the suits. Okay. Let's see here. Job openings to resume drop. We expect a decline in the job openings to accelerate. That was the expectation. Yeah, but the expectation was 9.3. It came in at 8.7. Okay. Kevin was hoping for a number under 9. We got a number under 9. Okay, it's good. It's good. The stock market's moving up. Okay, now what? We have, this drop in bond yields is really going to start putting a floor under real estate as well. So, keep that in mind. As rates are falling, the ISM numbers as well. As rates are falling, people start getting a little bit more ambitious about real estate. ISM numbers, prices paid. Ooh, tiny little bit higher than expected. We got 58.3 versus 58. And but we actually got a more positive services read of 52.7. Oh, but services employment comes in low at a miss, 50.7 versus 51.4. That's a way of potentially indicating, hey, look, JPOW, listen, man. JPOW, okay? You have done enough. You've got inflation. We saw the multivariate core coming down. Now you're starting to affect the labor market. Let's not let that self-sustain because that gets a poopy-doopy. Kevin, saying rates is falling. What about rates falling? So rates is falling or are falling? Isn't that like from Grammar Nazi on YouTube? You have to match your subject to your verb. Anyway, mortgage rates. Let me see the mortgage rates going into today for a 740 credit score. We're about 7.5. This is probably going to drop us to about 7.25. We're down 11 basis points right now on the 10, and on the 2-year, we're down about 8.3. Okay, let's go. All right, look at this, folks. Let's look at the sticks while we play what the SEC wants me to play. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. I know what you're trying to say. Akshay here, if I said that correctly, is saying I pressed the wrong button.
Go yourself. Is that clear?
That's awesome. All right, we'll see you again tomorrow at 5:25 a.m. 5:25 a.m. I'll be here, even if I only went to sleep at 1 a.m. because I was playing Rust at 11. I'll be here.